This is the Peer2Peer podcast. I am your host, Greg Stahersky. So, getting started with some economic highlights from the past couple weeks, and we'll start off with my all-time favorite asset, Bitcoin. We saw a new local high of 24,250 before pulling back into the 21,500 range in the last 2 days, as the overall market sentiment, not only in crypto, but in U.S. equities as well, has been leaning into more of a risk-off mentality. And on a longer time frame, we didn't quite reach the last bear market high of 25,200, which was back in August on the 15th. And we're still up about 30% for the year, although we're still down about 50% on a year-over-year basis. So to pile on a little bit of the bearish news, the S&P 500 also had its worst week of 2023, down about 1.1%, although it's still up about 6.5% for the year, coming off of one of the best January performances of all time. Although, again, year over year, we're still down about 7.5%, and that was also followed by an equally rough week for the NASDAQ, which was down about 2.4%, although it's still continuing to hold gains of nearly 12% for the year. And just taking a look at the bond market, yields on the 2-year rose a little less than 1 point to 4.51%, reaching its highest level since November 22nd of last year, which was actually the largest weekly gain since the trading period that ended back on November 4th. The middle and long end of the yield curve also saw some gains as well last week, as the 10-year was up about 6 points to 3.74%, followed by a 7.5-point jump for the 30-year, with each of those hitting their largest weekly advances since the end of December. Now, it's also worth noting the Fed had some interesting results from their Treasury auction this past week as well, with the 3-year showing rather weak demand on Tuesday. The 10-year, however, saw an overwhelming amount of buying interest on Wednesday, and the 30-year saw, we'll say, a respectable amount of bids on Thursday, but nowhere near as good as the 10-year auction that happened the previous day. Now, getting back into the equities market a bit, something I'd like to talk about is the incredible amount of volume that we've been seeing this year in the zero DTEs, which, if you're not familiar with the acronym, these are 0 days to expiration options. So you're essentially putting all of your hopes on a single session of trading in order to reach your strike price. Now, a large majority of the buying volume for these contracts is on SPY, which, again, if you're not familiar, it's an ETF that looks to replicate the holdings of the S&P 500. Last week, we saw almost 500,000 of these zero DTE options traded on a single strike in SPY. And about a week and a half ago, on February 2nd, we hit the highest options volume of all time in the U.S. equities market, with over 40 million call options traded that day. And it's not just SPY either. Tesla, TSLA, has also seen some eye-watering volume in short-duration options, racking up hundreds of thousands of these on a daily basis, especially as the price of Tesla has been on an absolute tear over this last month, and I believe it's posted something like a 60% gain in the last 30 days. Now, the question becomes, what exactly do we make of all this short-term thinking? Well, it's exactly that. There's an overwhelming urge for retail to get involved in these types of high-risk, high-reward, short-duration trades. And the fear of missing out has become a primary tool for the market to use in order to disrupt the foundation of even the most disciplined and patient investors. The fact of the matter is, a single bad options trade can undo months of hard work and good investing. When you start seeing this level of one-day option gambling, it's literally the perfect time to take a step back, reassess your strategy, double down on your patience, and stay disciplined. Now, it doesn't mean that you turn a blind eye to what's going on. Obviously, an event like the highest options volume of all time is something that you want to pay attention to, but you still need to be able to separate the signal from the noise. You need to be able to stick to your process, be patient with your investments, and always consider where you want to be over the long term. In reality, your portfolio will thank you for not getting caught up in the short-term FOMO. Now, on the topic of trading, I also want to talk about an event that occurred on the New York Stock Exchange, the NYSE, back in late January. And this story seemingly got swept under the rug and filtered out of the news cycle pretty quickly. But I personally witnessed this in my own trading account. Shout out to TOS. And although I wasn't adversely affected, I easily could have been. And I think it's worth exploring this story and some of the fallout from it. So on Tuesday, January 24th, an apparent quote unquote technical glitch on the New York Stock Exchange caused about 250 different stocks to make massive price moves. And we're not talking about penny stocks here. I mean large companies like Nike, Wells Fargo, Wayfair, Verizon, all experienced 12, 15, even 17% price swings in a matter of a few seconds, as soon as the standard 9:30 a.m. trading session opened for the day. Now, in addition to either adding or wiping out billions of dollars in market cap, about 80 of these stocks ended up tripping their circuit breakers, which is essentially a built-in halting mechanism that'll freeze trading when there's too large of a price movement in too short of a period of time. Now, as an engineer myself, and understanding that the markets are essentially pure software at this point, I was interested in the technical details of what exactly this glitch was and how it had occurred. But granted, the NYSE has not been very transparent at all on how exactly this all occurred. However, they apparently blamed it on a malfunction in their opening auction system. So, how this typically works is the exchange will match buyers and sellers up before the bell in order to set a sort of mid-range price to open the stock at. And unfortunately, due to this system malfunction or quote-unquote glitch, a number of these stocks had no auction take place on the session open. So basically, any order that was large enough on the buy or sell side was able to set that opening price, leading to these huge swings. Now, as you can imagine, a lot of people lost a lot of money because of this issue. Not to say others didn't make a boatload of profit on some of these trades, but let's be real here. No one is suing anyone because they made a ton of money. People will, however, file lawsuits for losing a ton of money, which is exactly what the fallout from this event has been. You have major trading firms like Robinhood, Charles Schwab, and even Ken Griffin's Citadel Securities all filing lawsuits against the NYSE, with losses totaling somewhere over $20 million. Now, to put this into perspective, actual trading was only open for a few seconds on a number of these stocks before the circuit breakers kicked in. So if $20 million can be exchanged within a few seconds, that should give you some idea of just how much money changes hands on a daily basis on the New York Stock Exchange. Now, to close out this episode, I do want to talk about the CPI report that came out on Tuesday, which was interesting for two reasons. The first being that it obviously came in a little bit hotter than expected, with prices up about 6.4% since the same time last year. And although we've seen a fairly steady decrease in CPI over these past few months, since it hit a high of over 9.1% last summer, prices have come up again about 50 basis points on a month-over-month basis. Now, second, another feature of this particular CPI number is that the BLS, or the Bureau of Labor Statistics, modified the formula that they use to actually calculate this number. One of the most impactful changes being that instead of using 2 years of expenditure data for the category weights, they'll be using just 1 year instead. Now, as many people know, this obviously isn't the first time that the BLS has adjusted this formula. In fact, they've been making changes to it since 1940. Now, although some of these changes have been useful in terms of keeping up with large societal and economic shifts, I do not know of a single person that actually believes these numbers anymore. So let's take this month's report of 6.4%, all right? If you're a tax-paying American, or let's say you're a head of household, there's absolutely no way you're going to believe that the cost of living has only increased 6.4% since this same time last year. We all know that price increases on the things that you actually need to survive, like food and energy and housing, have all gone up way more than that on a year-over-year basis. In fact, one of my favorite places to get an alternate look at this metric is on a website called shadowstats.com, which is run by a gentleman named John Williams. So what John does is actually pretty straightforward. You know how I mentioned there's all these revisions that the BLS has made to CPI since 1940. Well, what he does is he uses the methodologies that were in place in 1980 and reports that number based on today's price increases. So just to give you a better idea, a quote from his site reads, quote, "In general terms, methodological shifts in government reporting have depressed reported inflation, moving the concept of the CPI away from being a measure of the cost of living needed to maintain a constant standard of living." So as of today, using the 1980 methodology, CPI is actually closer to 15%. So just to make things simple, if you really want to know what the actual CPI is, whatever headline number that the BLS rattles off on their monthly report, just add 1,000 basis points to it. So if you're being told CPI is at 5.5%, well, it's actually closer to 15.5%. And like this month, if you're being told it's 6.4%, well, it's actually 16.4%. That is a much more real world and accurate estimate than what is officially reported. And again, I recommend you go check out John Williams' excellent site, shadowstats.com. It's got some great information on it that'll give you a much more accurate and honest answer to the question, how much more am I paying to survive every year? And I think that's going to do it for episode 3 of the Peer2Peer podcast. Just want to say thanks again to everyone for tuning in and listening. I really appreciate it. And as always, stay safe, be smart, and don't trust, verify.